Hello and good afternoon, everyone, or good morning to our people out on the West Coast. It's good to have you with us today. Let me just make sure everybody can hear me okay. If you see me and you can't hear me, let me know. Seeing lots of yeses and looks good and we can hear you, great, that's fabulous. I'm just looking at the attendees here. Wow, this is great. Let's see, we've got New Brunswick here too, so we've got some people from the East Coast as well. So you would be a half hour ahead of us, so that's great. Well, it's good to have you with us. We're in a much different place than we were last year when we had our start of year presentation. Those of you who attended last year's workshop, and that sounds like a foreign word, doesn't it? Attend a workshop, so long ago, but we had it in Toronto and Vancouver and Victoria, and we talked about some of the things we thought were going to happen in 2020. One of them was a market downturn, which seemed to happen almost right after our presentation, our workshop, but that's about the only thing that we could have predicted. The rest of the year, of course, I don't have to recap for you, but we will talk about some of the things that have happened and what the impact of those things are specifically with regards to investing and conserving your wealth and paying less tax. So what we have then is a whole bunch of information out there right now from places that are fairly reputable. We're talking about places like MNP and Moody's Tax and Tim Sesnick and Jamie Golumbuk, people that have been concerned with taxes and taxation for decades and are seen as experts in the field. And the common sense is that taxes are going to be going up. The consensus is that taxes are going to be going up, likely with the next budget. Keep in mind that there's a minority government in Canada, so the Liberal Party is going to need support of other parties to stay in power. And the NDP has already said they want to see capital gains go up on the sale of capital income, or capital gains taxes go up to 75%. The inclusion rate, they're currently at 50%. So, and I think there's been much speculation about this for a while, and it hasn't seemed to be quieted by the Liberal government. They haven't seemed to do much to try to assuage people's fears that this is going to happen. So what we want to talk about is, what does that look like to you if you own properties, and what does that look like if you're looking to invest, because your tax advantage may be lost. And that's a big hit, and I'm going to show you one of the examples shortly. So I think what I'll do is I'll change the presentation over to my screen altogether. And this is, you know, the articles that I'm talking about here have been out, and many of you have probably seen it already, or seen some of these already. And Tim Sesnick in particular, I know SafeBridge, they had Tim speaking to a group on webinar. Really reputable voice, really accomplished accountant. These are the RBC, for instance. I mean, this is pretty prominent. Now, one thing that I will say is that the big four firms haven't released anything yet about their outlook. But if indeed those come, those are the people who have the table with the minister, right, who sit at the table and really hear about these things first. So if that comes shortly, then you can almost guarantee that capital gains will be increasing in 2021. So what are we going to talk about? We're going to go through the tax bullets for 2020. What your year-end filing is here. So you're going to want to know what's changed for your immediate situation. Now, you know, there's not a lot of planning you can do if you wait till the end of the year, and especially if you show up with a shoebox at your accountant's office and say, tell me how much I owe. The planning happens earlier in the year, right? And hence why we're having these sorts of discussions. So I'm going to talk about some changes for 2021, because we want you to put plans in place. So in addition to minimizing 2025 taxes by taking advantage of whatever opportunities there are, also consider putting some plans in place. What can you do about capital gains increases? What are your options? And then for 2021, what kinds of things should you be looking to do in terms of investing or protecting your wealth? All right. So to recap last year's workshop, by the way, these were some of the things we talked about. We talked about there being a stock market downturn likely in the next, well, in the first few months of the year, and it actually did come. We talked about some of the tax changes, the 100% write-off for zero emission vehicles, by the way. That was a really terrific opportunity that some of our clients took advantage of. And unfortunately, what we've also seen is CRA is now auditing people who have claimed this deduction. So it's really, you know, part of our frustration as tax practitioners is that they're putting tax advantages in place or programs in place, the government is through legislation, but CRA is clamping down on things. And we're seeing that with CERB and with CEBA and with the wage subsidy and all kinds of other things. And it is a continuation of the complete culture change at CRA since I was there. I was last there in 2013, and the emission vehicles, great deduction. Unfortunately, CRA is deciding they want to audit some of these. So it goes. And here's what I'm talking about. So last year we told you CRA announced they're going to devote $50 million over the next 5 years, and this is their quote, to make sure real estate investors are paying their fair share, right? So this is what is concerning to us, is the increase that we're starting to see on routine types of property transactions, rental properties, et cetera, and the denial of some things that are legitimate expenses. So your strategy with your account has to be to make sure you are audit proofed, to make sure, and not audit proofed in the sense that you won't get chosen for audit, because it's happening more and more. Look, they're dedicating a massive amount of money to this. But your plan has to be that when it happens, you're covered. Okay, and this is about sleeping at night, frankly. I'm seeing some tax strategies out there which are very dubious. I'm going to talk about some. One is called a TFSA maximizer, and some of our clients have brought that to us recently. And these kinds of strategies are things to be wary of, because what we want you to do is grow a portfolio of income producing properties and conserve wealth for you and your family, and be able to live off the income you're producing and sleep at night and do all this comfortably. And some of these strategies are not going to produce that. I'm going to show you an audit in a couple minutes of one of our clients that was completely unreasonable, but has caused tremendous hardship. So available for rent rules, capital cost allowance change. And then we talked about last year Airbnb and RV park risks. Wow. Airbnbs last year we said were going to be a risky item to be investing in. And wow, this year, how prophetic was that? Who could have predicted what would happen? But for any number of reasons, we told you to watch out for these two areas. So that was 2020. Oh yes, and then of course the GST rebates and refunds and the increased scrutiny there. Anyone who has been trying to get an HST rebate for a property you may have built for yourself or a rental property, you might have run into some problems lately, right? Because of the increased scrutiny here. And some of the issues that are coming up. For instance, if you hire a management company on a guaranteed rental, monthly rental amount for you, you might lose your HST rebate. That is, you might enter a rental program, right? Where you buy a property and you enter the rental program, where essentially a rental management company says, we'll go off and find tenants for you to make sure your property is tenanted. And you think all's well and good, except CRA now determines that you don't actually have a lease with someone for a minimum of 365 days and asks for your HST rebate back, or otherwise denies your claim for one. So that's still happening. Okay, let me just see what our screen looks like here. So some bullet points, we're going to go through these. Again, you may want to make some notes about some of these things, because This is going to directly affect your 2020 filings, or it could if you fall into one of these categories. So make notes. If you have questions, we can come back to it at the end. Chances are, if you have a question, it's probably the same one that other people have as well. So it'll be good to hear it. All right, tax deductions. What can you deduct? We're always asked, what can I deduct? What can I deduct? Well, here are some of the things. Did you subscribe for anything out there? Did you sign up for Prime, Amazon Prime? Did you sign up for a news service? Did you get the Globe and Mail or the Calgary Herald or whatever it might be? These are all deductible expenses, okay? Moving expenses, child care expenses, of course. By the way, 100% of moving expenses are reviewed by CRA, okay? The accountant doesn't do anything wrong when you get a letter about your moving expenses. It is a mandatory review by CRA that if you claim a deduction for moving expenses, it will get reviewed. This is important to know because we're not going to play fast and loose with the type of expenses you're going to claim. That's only going to cause problems for you. So we want to make sure everything is documented and they are legitimate expenses, all right? Child care expenses, charitable donations, political contributions. Who would you contribute to? I don't know. What possible political party is in our best interest, it seems right now, at least for those of us trying to grow businesses and do things for ourselves. But nevertheless, maybe you found one or someone that you want to support, and that's deductible. Medical expenses, alimony, employment expenses, union dues, etc. Carrying charges is a big one. If you borrowed money for a particular investment, perhaps you're using a cash damming strategy to convert mortgage interest on your principal residence to tax deductible interest. Well, these carrying charges and interest expense are important factors, okay? Home office expenses. So a lot of people had to work at home during the pandemic. You are entitled to claim a home office expense, all right, for working at home, but this is not very lucrative, just so you know. It's a maximum of $400, right? This is different than the home office expense you may have got in the past when you got a T2200 form from your employer, whereby you claimed probably a lot more than $400 as a deduction, all right? This is specifically for employees who would otherwise be showing up at an office every single day to perform their duties, have had to work at home, and now this year you'll be able to deduct $400 or up to $400. It's $2 per day to the maximum number of days, which is 200, all right? The good thing about this is you may have 5 people in your home who all had to work from home. Well, each person can deduct $400. It's not a per household limit, okay? It's per person. So the form you'll need to fill out for that is called a T2200S, all right? That's the form, but we're gonna make sure every single one of our clients at least gets this deduction because there's no doubt if you're in most urban locations, you had to work from home. Again, this is Canada. I know we've got a couple people on here in Orlando, guys. You may not have the same sorts of consequences or implications here for these types of deductions on your cross-border taxes, but this is specifically Canada I'm talking about. Now, also, if you got CERB in the year, there were no taxes withheld from this. Now, most people, I think, know that, but some don't. Some don't realize that you will have to pay tax to the government at the end of the year, potentially, on the CERB payments you received. You may also have to pay some back if you weren't entitled to it, but that's a different matter altogether. That was always the case. But CERB is included in your taxable income. You'll have to pay tax on it. There are clawbacks for your income, okay? What replaced CERB was the Canada Recovery Benefit. So if you make over $38,000, 50% of every dollar earned in excess of $38,000, you'll have a clawback on your Canada Recovery Benefit, okay? That's important information, but it's also not just from the fact that you're gonna have clawback, but also for you to realize that you can qualify still for this CRB benefit. You just may have to, you may qualify only for a reduced amount. Employment insurance. So if you earned in excess of $67,000, you may have some EI clawbacks. Canada Emergency Response Benefit, that there is no clawback on. Okay, there was eligibility rules. Maybe they'll determine you weren't eligible, but there's no clawback on that. Now, seniors, those over 60 and 65, well, 65 in particular, if you're getting old age security, there is clawbacks. And we run into this problem every year, especially with our clients who have corporations and are determining how much to receive from their corporation remuneration for the year, right? Because depending on how much you receive, you may affect your OAS benefit for the year. You may have to pay some of it back, okay? And those are the levels right there. The other thing we want to talk about with people who are turning 60 or are in their 60s and haven't yet taken CPP is, does it really make sense for you to take it at 60? Should you defer it? There is a calculation to be done. Now, you know, all of these calculations have assumptions in them. And of course, one of the assumptions is how long do you plan on living, right? Some people are fairly realistic about that, thinking, you know, well, what happens if there's only 5 years left? But others need to look at some actuarial tables, and we can help with that. And I think that's important because it can be thousands of dollars a year difference depending on when you take it. So let's do that analysis. Don't just sign up for your CPP the moment you turn 60, okay? Or hold one of those CPP parties that people seem to be having when they turn 60. Okay, so if you had a business or a rental property in the year, we talk about this every year, and it is indeed one of the major strategies of having corporations or businesses is paying income splitting, essentially, by way of paying salaries to family members for services rendered. You know, some of the things you can say were delivered, not say, some of the things these family members delivered for you would have been website maintenance, admin support, janitorial services, okay? These things are, and that was the change that happened a few years ago with CRA, that came into play, the requirement of reasonableness, okay? It used to be you could just pay, not necessarily a salary, but you could pay dividends to any shareholder in the corp, and you could split income this way, and there was no reasonable criterion. Now it has to be reasonable remuneration for reasonable contribution. And if you are going to pay yourselves or your family members a salary, let's document it. Let's keep track of the work that they've performed for you. Let's make sure you're sending emails back and forth. Let's make sure we see them setting up appointments for you and so on and so forth, okay? That's critical to making sure CRA cannot later deny these salary payments. If you made a capital purchase in 2020, again, there's an accelerated depreciation. These are tremendous opportunities, right? You can generally take 3 times the deduction that you'd normally be entitled to. All right, again, this is Canada for our clients in Orlando who are on here. We're going to get to you, don't worry. We'll talk about some things specifically. In the US, there is also accelerated depreciation, right? That's a wonderful opportunity as well. This is available in Canada in 2020. So for those of you who bought a new rental property or bought assets for your business in the year, let's take advantage of that opportunity, all right? RRSP contributions, look, you will have to determine whether RRSPs are right for you, and we want to have a conversation about whether they're right for you. Just because you have contribution room doesn't mean you should necessarily be investing in an RRSP. The analysis often comes out that investing in a TFSA with the money you would have put in the RRSP ends up being better for you long-term tax-wise, or putting the money, investing in your personal name, or using the money in a corporation, whatever it might be. But if you are going to be contributing to an RRSP, let's talk about that, and let's also talk about maybe you're going to use a spousal RRSP. That'll give you greater tax savings. It isn't uncommon for someone to contribute to their spouse's RRSP, and 2 years later, the spouse can take it out because the spouse is in a lower tax bracket, and essentially there was a big tax gain there, right? A big tax savings. Zero emission vehicles I talked about earlier, 100% write-off in the year on the first 55 grand, including the HST component. These are big opportunities. If We're seeing a lot of real estate agents, frankly, buying Teslas. Okay, here is an example of a high income producing business, which can really take advantage of this deduction. Had they just gone out and bought a single vehicle on their own, so this is a $55,000 write-off, to give you an example, if you just went out and bought a non-electric vehicle, the maximum write-off you would have gotten in the year is, let me just do here, $6,000, okay? So you can take a $30,000 capital cost allowance, but you have to spread that over 5 years, which means if you go out and buy a normal vehicle, you get a deduction of $6,000. If you go out and buy a Tesla, you get to deduct $55,000. So maybe we should be connecting with a Tesla dealer to try to get some sort of commission off sending all you people over there. But needless to say, it's something to consider, right? And of course, there are a lot more money and so on and so forth. But after tax, that's what we're talking about. What happens after tax? Are you in a better position? If you lost money this year, okay, you might be able to claim allowable business investment loss. And every single claim for an allowable business investment loss is audited by CRA. So again, it's not easy to get, but if you did indeed lose money by investing in a Canadian small business, then, and it might be your family's business, it might be your son's business that you invested in and it didn't work out. There are a lot of businesses this year that sadly are gone, right? So if that's the case with you, well, let's make sure at least you can get a tax deduction for the investment you made in it or your family member made. And then of course, splitting Canada Pension Plan, this is always important. This can help reduce your taxes significantly. CEBA loan. So a lot of our clients have businesses, corporations, and they've availed themselves of this, right? The criteria was fairly liberal, all right? And they've extended this loan to March 31st, 2021. So that's important to see that the extension is there. Look, it's $20,000 free income to you, okay? So the loan is for $40,000 the first tranche and $20,000 in the second tranche, and each of those tranches has a $10,000 forgivable portion if you pay it all back by the end of January 2022, so for a year. So if you just borrow money, they're going to give you $20,000. It seems to me like a no-brainer. Why some people have said, well, we don't want to take on the debt right now, I'm not quite sure. Perhaps we failed to explain it clearly enough, but I've tried to say over and over again, it's $20,000 free money. All right, till March. However, if you did get the CEBA loan last year, or if you got the wage subsidy, you have to understand that that's income to you. At least the forgivable portion of the loan is income to you. And you will either have to report that income in the year or take some sort of accrual or reserve for a future year's reporting. In either case, you have to elect this amount on your 2020 tax return. Okay, this is critical. And these are the areas where we don't want CRA coming back later and saying you didn't do that, because what else will they be looking at when they come back? That really is the problem. Is these, they used to hold what are called restricted audits. Restrict the audit to a particular concern, go in, answer that, and away they go. And now we're just seeing a very broad inquiry asking for all kinds of other things, and it's really something we want to avoid, okay? So, got to include as income, important to know. So, remuneration strategies. Look, I've put this here first. This statement, right? Higher levels of personal income are taxed at higher personal rates, while lower levels are taxed at lower rates. That's probably the most elementary thing we could ever say as accountants. That's probably something you know instinctively, right? And yet it is also the most important thing to remember when we're trying to talk about tax planning, right? Because what if you're going on maternity or paternity leave? What if in a current year you're potentially going to get a large bonus or a dividend? What if you sold a business this year, or a rental property, or some other investment? Okay, there has to be a fundamental understanding of that first statement that appears there, because we can smooth income over multiple years, but we have to have a strategy to make sure that your income that you're receiving is not necessarily going to be taxed at a higher personal rate. Okay, that's critical. What if you're going to lose your child tax benefit, or your disability benefit, or your GST or OAS because you're receiving more income in a current year? Have you accounted for all these things? Have you come up with a strategy to make sure that those don't happen? All right, this is what's called tax planning, and that's exactly what we want to try to do. Smooth income across low and high years. We want to defer taxes. We want to increase the amount of money you have. We want you to grow your business and investments and your net worth, and we want to conserve wealth for you and your family. There's the definition of tax planning. Okay. Whatever you're going to be doing in order to achieve that first goal there, that long goal of doing all those things, we have to use these types of things in your strategy. All right, these types of things will form part of your strategy and part of your planning. Corporations are number one on the list. They will stay number one on the list. They are going to be number one with an asterisk and an underline and highlighted in future years if capital gains go up. Okay, but all these other things as well. Trust. Do you have a family trust? If you're doing joint ventures, do you have a plan in place for the joint venture? Are you doing REITs? REITs are a tremendous opportunity if it's the right REIT. Limited partnerships. Insurance. Insurance is a major tax planning opportunity, especially for high net worth individuals, okay, and for individuals who have high capital gains accrued on properties or in investment portfolios, etc. And leverage is the last thing, because a lot of tax planning involves being comfortable with leverage, or reducing or increasing leverage accordingly, depending on what your goals are. Okay, so can everybody now see the slideshow so that we're going forward? Okay. Yes, we got yeses. Right. Again, this is so folksy, and this is why I love being in person, because folksy works better in person, doesn't it? All right. Okay, so hang with me. It's going to get better here, folks. I promise you. Let me get back to my screen, my PowerPoint. So let's go. You know what? I'm going to share this PowerPoint with everybody as well. And by the way, we will have this on recorded. So if you didn't see it, you can watch it. Or sorry, if someone you know wants to see this, they'll be able to watch it on, I guess, on this platform. But we'll let you know. So again, here was the point I was making. This is the major point, right? Higher levels of personal income are taxed at higher personal rates, while lower levels are taxed at lower rates. Here are all the things that impacts. These are all the important things that statement impacts, and it's why we need to keep it in mind, all right? And everything we do in tax planning is to achieve this goal right here, to smooth income across low and high years, to defer taxes, to increase the amount of money you have, to grow your business, investments, net worth, and conserve wealth for you and your family. That is the mission statement of the strategy you're putting in place. You want to check all these things off when you're doing your tax strategy to say, it does this for me, and I know how, okay? So in order to accomplish this, these are the things we need to use. We need to use corporations. Someone asked about PRECs for real estate agents. Yes. If you are a real estate agent, get a PREC, get it now, get it immediately, start using it, okay? These are opportunities you have to take advantage of, and these are the tools to make sure we accomplish that first thing. So there we go. We're on to 2021 tax changes. Let me just take a second here. Are there any questions about those things so far? And granted, you may not have seen slides. Can I make it full screen? Will you send the slideshow to us? Absolutely. What is a PREC? PREC is a personal real estate corporation. These are, if you're a real estate agent, you should be using these precs because they are opportunities to lower your taxes and conserve wealth, defer taxes, all those things that we talked about. Some provinces were allowed real estate agents to incorporate a long time ago. Some haven't until now. Ontario has been the latest, but definitely use a real estate corporation. So, sharing your screen. Any other questions there? If you're a real estate agent that doesn't make a lot of income, does it make sense to create a PREC? Well, the use of a PREC is to conserve tax, or to lower the tax rate on the income you're making. So if you don't have any income, or if your income is low, I like to use an amount somewhere around $40,000. That's a low amount. Some people are saying, oh, you got to make six figures. No, I would say $40,000 because there are other benefits to using the corp. So if you are making $40,000 a year or more as a real estate agent, then use a PREC. If you're not making $40,000 a year, then you're just doing real estate as a hobby, and it may not be necessary for you, okay? So I'm gonna get back to the full screen here and go from there. So here are the tax changes for 2021, okay? CPP is going up. So you're going to see this right on your tax rate, on your paycheck. If you're a T4 employee, your CPP has gone up. Your EI has gone up. Not the deduction amount, but the total amount that will be deducted from your pay. Your the tax brackets have been indexed to inflation by 1%, so they've gone up. Corporations. So here's why we need to get plans in place now. You may already have corporations in place, but people are mixing active businesses with passive investments, and it's a problem. And that's why we need these PRECs to stand over on their own. You're not going to use your current corporation that you have 4 other properties in. That'll be a sister corporation, but or any other type of active business that you're operating. If you're a doctor, if you're a dentist, you're not going to buy properties necessarily in your practice, in the corporation that you're operating your practice out of, because it's going to affect your small business deduction the moment you go over 50,000 in passive income. Okay, so these are recent changes that we have to plan for. We have to make some adjustments so that we can achieve that goal that we talked about earlier. All right, there's a new American president. There, we got something for our US folks, but also for our Canadian investors in the US. Why is that important? Because there is talk about a rollback of some of the tax changes. There's a talk about increasing capital gains taxes in the States. What plans can you put in place to mitigate against those happening, right? There is this one, the increase in the capital gain that's on the horizon for both Canada and the USA. So that's the big point that a lot of you are concerned about, and we'll get to that momentarily. So this is the other thing that's occurring that I talked about. The culture at CRA is changing. Here's Tim Sesnick's article on it. He talked about being in this world for 25 years, and he's never seen such inflexibility as is occurring right now. Things that used to be solved with a 5-minute conversation over the phone are now turning into multiple levels of review and appeals and objections, and that sadly is costing the frontline taxpayers more money, okay? Because these advisors, us advisors, you know, we do charge to do these things, and it would be much simpler for us if we didn't have to do them. Believe me, these are painful things to have to do despite getting paid for it. I'd any day rather deal with you and your growing business and plans and things that we can put in place than I would have to deal with CRA and create exhibits and all number of submissions to try to prove that you're entitled to what you're entitled to. So I'm going to give you a case study right here. And this is a client of ours. This was before we were the accountant. This is an audit of 2011, okay? 2011, and this, if you look at the date of this audit is occurring in 2017. This is called a net worth audit. Guys, we have at Real File CPA 2 former criminal investigators, myself and Johnny Ardisi. We are probably the only firm anywhere in Canada that has 2 former criminal investigators and CRA auditors on staff, all right? These are what we did. In fact, I was the leader of the Toronto North region, which is the largest tax office in Canada. Toronto North stems from Lawrence Avenue all the way up to Barrie and Orillia. The largest tax office in the country. I was the leader of the net worth program. This is not meant to be a boast. This is to tell you that I know net worths. In fact, the people that are delivering the net worth program are probably using the same documents and guides and training materials that I created and helped create, okay? So I know a net worth analysis. I know fundamentally how these work and how they fail and how to defeat them. But also I know when they're gonna stand up and you're going to be able to, and you can't do anything about them. So this is a case, a client came to us, she's a real estate agent, all right? And this net worth analysis, here's the essential part of a net worth. The net worth says CRA doesn't care anymore about what you wrote down on your tax return, okay? They couldn't care less that you report $100,000 on your tax return. What they say is, where did you go on vacation this year? How did you go to Cuba 5 times? How did you buy that car? How did you pay your rent? How did your child go to university? How did you go out for dinner 48 times? How did you pay that Visa bill? How did you put a pool in your backyard? How did you get that landscaping on the front that looks wonderful? They say, in other words, your lifestyle, how did you pay for it, right? So they add up the costs of your lifestyle for the year or a series of years. And they say the lifestyle that you lived would have cost somebody $500,000. Now we're going to look at your tax return and see that you only reported $100,000. Well, you owe us taxes on $400,000 because there's no other way you could have paid for all those things, right? So I'm not going to go into the ways that you can defeat a net worth analysis, but in this case, this is a taxpayer client who had a corporation. The corporation did renovations and construction, and she was also a real estate agent, okay? So this is where it gets tricky because CRA has to look in multiple areas to see where income might be coming from. But this is essentially an audit of a corporation to say, if you look at 2011 and 2012, we think your unreported income is $142,000 in 2011 and $163,000 in 2012 because you lived a lifestyle that needed that much money, and we don't see that much money reported on your tax return, okay? If you look at the P next to those amounts, the P is critical, okay? The P means that these amounts are subject to penalty. The penalty is 50% of that, okay? The taxes are 50% of the amount. So you can see how serious this is. This is 6 years later. Can you imagine having to go back 6 years prior to figure out where your money was spent and how to prove that it wasn't personal living expenditure 6 years prior? This is a person who had to buy supplies and all number of and incur expenses for labor and contractors and such subcontracts to do the builds and the work that was done. It is almost impossible to go back 6 years ago. Most of us can't look at last month's bank statement and figure out what some of those things were. Can you imagine 6 years ago? So this is why people are so handcuffed by this. This audit comes 6 years later. So the client comes to us and says, can you help me? Because I'm getting audited for 2011, 12, 13. There's no way that I owe this much money. So the penalties and interest are more than the taxes. And in many cases, what all this adds up to is more than the actual income itself, all right? So this is just one example. So with that net worth audit, they came to us, and I'll just stop sharing for a second here and go back to the screen. So with that net worth audit that came to us, this is what we're seeing more and more of. The CRA is not auditing you and your receipts anymore, okay? And I've said for the longest time, you don't need a receipt to get a deduction. Anybody who tells you you can't get a deduction without a receipt is wrong. I've been in court where the judge has said, I believe you incurred that expense, and I know you don't have a receipt, not to me, to the people who are auditing. Therefore, we're going to allow the deduction. The Income Tax Act does not say, you need a receipt to get a deduction. It only says you can get a deduction if you incurred an expense for business purposes. So that's the point that needs to be made. But CRA is looking less and less at these. Someone has asked, writing is unreadable, agreed. It is a letter from CRA. It's all kinds of gobbledygook. But anyway, what prompts a lifestyle audit? Well, being a successful person, earning income, okay? Higher net worth individuals, people who own properties, people who run businesses, real estate agents, businesses that are seen as earning a lot of income will lead to net worth audits. Criminal activity also leads to net worth audits, by the way. So not that we want anybody involved in criminal activity, but that's something that leads to a net worth audit. So how does a net worth audit happen? Here's how it happens. Essentially, if there's a screening program at CRA, they use logarithms. How they choose who they choose for audit, we don't know. But every audit that begins, and they're happening more and more, every audit that begins is supposed to begin with what's called a decision tree analysis. The decision tree essentially says, okay, is there a potential for a large amount of unreported income? And depending on how the auditor answers that, will lead them through a series of questions to arrive at either a net worth or a factual audit. So how far can CRA go backwards? As far as they want. They can go back 40 years if they want. There's no requirement, okay? CRA, we're told we have to keep, and here's the problem, we're told we have to keep receipts for 6 years, but CRA can audit you for 12 years ago, all right? How can they do that? Because Section 152 of the Income Tax Act says if you committed negligence, 152.4 says if you committed tax evasion, then there is no statute barred period. They can go back as far as you want. In practice, CRA tends to only go back 10 years maximum, but in theory, they could go back much further. There was a program, by the way, called the Voluntary Disclosure Program, which allowed you to essentially come clean to CRA. And a lot of people took advantage of that over the years where they may have had unreported income from 8 years ago. Instead of getting hit with those penalties, CRA said, hey, come clean with us and we will not charge you any penalties. So a lot of people came to CRA at that point in time. So many, in fact, that CRA realized that we're failing. If we're not catching these people, there must be something wrong with our processes. So let's increase our scrutiny, let's increase our compliance regulations, so on and so forth. So the Voluntary Disclosure Program, as good as it was, and accomplished some things, it also resulted in increased scrutiny. So let me go back to the presentation now, get through. Now that we've gone through that, share your screen. Entire screen, share, okay. Is someone tipping CRA to this? So CRA has what's called the tips line. My last year at CRA, 2012 or 2013, the tips line in Ontario got, I think, 19,000 calls, okay? 19,000 calls. The tips line was in St. Catharines. It was a small room of 6 people taking phone calls. So those 6 people took 19,000 calls in a year. That's a lot of calls every day, all right? Those people had to do an immediate review of whatever the tip was about and determine if it had some sort of legitimacy to it, and then they might send it off for a second review, and if it indeed seemed like there was some substantial tax evasion at play, they would then go off and refer to audit. But I'll tell you who most of the tips come from. They come from neighbors who see a brand new car in the driveway, a brand new Lexus, and are very unhappy about that. They come from ex-spouses who know where the money is and know that there's a bank account in the Cayman Islands. They come from ex-business partners who know that their former partner has a whole bunch of money hidden somewhere or stole money or has unreported income. Those are the majority of the tips that come in. Those are very credible sources, right? Especially the ex-spouses who really have, may really have some ulterior motives in getting and are looking for a pound of flesh. So all of which is to say, don't commit tax evasion. We don't want clients committing tax evasion. You are going to put yourself into a planning and a strategy regime that will stand up to scrutiny. And if there are marital breakdowns or business breakdowns, it will stand up to scrutiny. Okay. So let's go back to my workshop here. So having said all that, all those things that we have to worry about, let's see if we can get this one to play here.
This is a big problem we have here.
It sure is.
Yes, it is.
Big problem.
Competition is killing us.
That's true.
Very much so, yes.
They really are.
We need a new strategy.
We sure do.
Strategy will be good.
Totally agree.
I need new people.
Yes, you do.
New people.
Definitely.
Here's the plan.
New people.
Yep.
Yeah.
That's the solution right there. New people.
Okay, did that come through? Could you hear that? That was sort of the, oh, good gravy. You couldn't see it. All right. Well, hopefully when I share this PowerPoint, it'll come out better. Essentially, the question is, what is the strategy and what have you been doing up until now and how's it served you, right? Are you further ahead? Did you double your income last year? In this period of incredible growth, in this period of incredible opportunity, did you double your income? Or are you still where you were last year? Are your investments generating enough cash flow that you can see retirement on the horizon? You can see the vacations you want to take, or are you still where you are? Are you exposed right now to a tremendous amount of tax that you have no plans to deal with? You have no way to be able to mitigate the taxes on those if you want to pass those along to your children. So these are all the kinds of strategies that, and where are you getting your strategies? Because so many of our clients, I have to tell you, you're paying us monthly, and then you come to us with something you heard somebody else say is what they should be doing. Okay, but how's it working out for them? And is it even legal? And have you analyzed what they're talking about, right? These are the things that really boggle my mind, because we've grown this practice now in 6 years. Alan and I have grown this practice. Where did we start? We started, Alan and I and Bell, and we started in a small office in Mississauga that we were on top of each other. We're still in a small office, but now we're in Markham, which is a much better part of Toronto, for those who don't know. CRA, much nicer than Mississauga. Apologies to people who live in Mississauga. It's just that traffic by the airport is awful. But we now have 7 CPAs on staff. We have a US CPA. We have 3 full-time bookkeepers. We've grown every year by following our own rules about growth, about how to develop a business, about how to invest in ourselves and invest in services that will deliver returns, okay? These are the same things we're trying to, and by the way, our clients have grown with us. These are the people who started with us, and we've seen them grow, and it's incredible because they've done the things they need to do, and they've structured it in a way that what they're making isn't getting eaten away by taxes. So these are wonderful success stories that, frankly, we'd like to see the 80% invoked, not just the 20%, because we still have 80% of the people who want to analyze a deal 58 different ways and just can't pull the trigger on it because they're paralyzed and they're no further to where they need to get to than they were last year. And it's just, to us, it's heartbreaking, especially people who've set up corporations, done the structure, paid Keyspire 25 grand, joined RAIN, or joined all kinds of other groups, and are still looking for a first income property. So we're going to pull you across the finish line, okay? But stop going elsewhere and bringing half-baked strategies and ideas back to us. All right, there's my diatribe. You'll get a kick out of that video once we get to it. So back to slideshow. So what are the problems we're seeing with your strategy? You're spending, but you're not earning. You're not tracing your expenditures to net income. That's what I'm talking about. Endless amounts of training programs and structuring without having an idea of what you're going to do. It's great. We want you to put a structure in place. We want to create a corporation or a limited partnership or a REIT for clients who are growing. That's great. But do you have 40 offers out there yet for properties? Do you have 58 people that you've talked to invest in your business? These are the areas that you got to concentrate on. Activity, action, taking action, not just spending on things that are going to save you money. Once you make money, you got to make the money to save the money. Unclear goals. What exactly are you trying to accomplish? What does your income in retirement need to look like? What does your income need to look like so you can leave your job that you don't want to do anymore? What does your income look like so that you can build a financial wall around your family, because you know your children are going to be facing a future that is going to be much different than you faced. You're worried about their opportunities. What does that look like? How do you quantify it? How do you feel it? How do you see it? Reliant on disjointed advice. You can't go to 5 different places and get advice and then expect that you're going to have a plan that's going to work for you. We have clients who operate on both sides of the border, okay? And they have accountants in the US and lawyers in the US who have 7,000 accountants in their office, never mind 7 CPAs. And the best advice you can get for your money in the US. And they're putting all types of hoops in place for the Canadian side of things that are ultimately not saving you money and are ultimately costing you money. So you need a type of advice that is holistic, that has the big picture in mind, all right? And that's not just for cross-border, that's here in Canada. You know, I was mentioning to a client recently who was talking about, well, maybe we just want to bring our real estate business to you. Okay, fine, then maybe we just want to help you save a little bit of tax, right? Maybe we just want to help you get partway to your goal, right? Because we can't put a holistic place, of a strategy in place if we don't have an understanding of all the moving parts that are occurring with you in your life, okay? And all your activities, business, investment, and so forth. Investments that do not deliver. Well, this is a strategy problem. You know, some of our clients might be on here. I know a lot of clients got an opportunity through an investment network about 4 years ago. They were put on to an investment in Fort St. John, Alberta. And the investment looked so good when it was presented at the front of the room from that investment network, which otherwise does great work, of course. And it guaranteed your rent for 1 year. And I remember doing an analysis for one of the clients late at night, and I said, this is a horrible investment. This is awful. And I heard, well, what about the guaranteed income for a year? They're promising to rent it out for a year. I said, yeah, but then what? In the last year, we've had clients look to sell their properties in Alberta at losses so that they can finally, after far too long, go off and invest in income-producing investments elsewhere, okay? The real property didn't work out. For the clients who invested in those Fort St. John, sadly, after the first year, those properties have sat vacant for 2 years, many of them, okay? And they can't even sell the properties for what they bought it for. So lean on us to say, here's an investment. What do you think of it? And when we tell you, we're not going to advise you. We're not financial advisors to say, do this one or do this one. But when we tell you that that's not a good investment in our view, maybe you want to listen to it, right? And if we say, hey, this is a good investment. My partner, Alan, has been investing in the stock market since 1996, okay? He's been an investor in the stock market since 1996. So that's 25 years. How many people have survived 25 years through the crashes in 99, in 08, in 17, in 20? How many people have survived? So what he will tell you is the market doesn't owe you anything, right? The market, neither the investment, the real estate market, nor the stock market owes you anything. It is not a cash machine that you can go to and expect to pull money out, all right? These are things that take scrutiny and analysis of a proper kind. And that's what we want you to really rely on us for, right? In 2021, analysis of the investment you're making, consideration of some of the options that we're going to say are good options for you, and then structuring it appropriately so you reach your tax planning goals. Don't take the time to optimize yearly revisions of your plan, and then bad assumptions. You know, the people who are speculating that their private lending is never going to go to zero, that they can't lose it all, that they can't possibly, are making a bad assumption. Your private lending has no collateral. Your private lending has nothing underlying it to make sure that even if someone can't pay you the bill, there's something there. That's a lot different than investing in a REIT or a mutual fund trust or a real property or a joint venture with someone or a limited partnership or insurance for that matter. All right. So bad assumptions. All right. So crafting a plan for 2021. Here's what we want to do. Let's cut to the chase. Consider selling anything that's not producing income. Stop thinking speculation is your way out of things. Consider selling anything that's not producing income. That is, if you have a rental property that's not cash flowing, you got to do something with it. You got to do something, either sell it to yourself, to your corporation that you'll create, or sell it to the market as a whole, take the money and find producing assets. In this period, when capital gains taxes are likely going to be going up, speculation doesn't, increases in value are not worth as much as income, right? The cash value of money down the road is not worth as much as money today that you can grow. So important to understand, after tax, that is. Reevaluate your investment based on income potential, not its appreciation. That's what I just said. Consider transferring properties, stocks, investments to a corporation. Even properties that you might be selling soon. I'm going to show you something really terrific, okay? If you own a corporation, if you have a retained earnings in your corporation, consider selling that property to your corporation. Oh yeah, but Dave, there's land transfer tax and, you know, there's going to be fees to pay. Yeah, but watch how much you'll save. Create a corporation and family trust for you and your family. If you are a high net worth individual or you're going to be one and you don't have a family trust, well, you got to get moving. You need a family trust, okay? Purchase insurance. Insurance. That's going to be a buzzword that you'll hear from us over and over. If you have a corporation, that's going to be possible to get tax exempt insurance, not only the a deduction for the contributions you make, the premiums, but also the insurance payment that comes out will be able to be tax exempt. All right, big opportunities, and IFA, which our friends at SafeBridge are big proponents of. Chris Karam, I know, has talked to several clients about this. This is insurance in your corporation that actually you can borrow against. So you're not even out of pocket anything. You're actually able to leverage the insurance to grow your portfolio. It's a win-win-win. Okay. So these are the things that we want to talk about for 2021 that you want to start doing if you haven't been doing already. Now, income producing investments. So what do we like to see? So I'm putting REITs and mutual fund trusts up here. The reason I'm putting these is because a lot of clients are passive investors. You might be 65 years old and you don't want to go out and buy your income property. Fine. But I am going to suggest to you these are much better options than passive than private lending, okay? Because these have underlying assets. They produce high dividends, they're a hedge against inflation, they have reduced volatility, and REITs and mutual fund trusts with properties underlying them have outperformed the S&P over the long term. Not in the last 6 months, of course not. In fact, I wish a lot of us had bought the S&P back when my friend Alicio Siriotakis at SafeBridge, we went to, I don't know if Elisa's on this call, we went to see Barack Obama speak at the convention center last year, and the market had just turned down, and he showed me a stat that the S&P, after a particular downturn, had rebounded some substantial, ridiculous number in the months to come. And I know Alicios would have put money in the S&P because that's how he operates, right? But we're conservative over here, so we had our conservative investments, but the S&P was great the last 6 months. Advisors like SafeBridge can help you with those sorts of things. But having said that, a REIT, the majority of the REITs that are traded publicly have outperformed the S&P over the long term. So if we're trying to decide between equities and REITs, I'm going to say REITs. If you're trying to decide between a passive investment and a REITs, I would say a REIT, okay, for all of these reasons. So again, we still like some income producing properties, okay? We still like, and I'm going to get to that in a second. So actually, that's another slide, but let me just end show for a sec. Any questions to this point about that? What's the definition of high net worth? What's the minimum dollars be considered high net worth? So high net worth individual. So we have a really good friend of ours, Mark McEwen, wrote a book called The $6 Million Dentist. Okay, the $6 Million Dentist. I've talked about that in past presentations. Mark has been doing financial planning and estate planning for dentists, specifically for dentists, for 25 years. And he would say that fewer than 30% of the dentists, and we think of dentists as a profession that tends to be higher net worth, that tends to have higher net incomes, that tends to do pretty well. He would say that fewer than 30% of the clients he's dealt with in 25 years have ever reached $6 million in net assets, okay, at retirement. So if we use $6 million as and above as a high net worth individual, that's probably too low. But I like to use $6 million because planning has to be done. If you're $6 million, you have to do that. Because if you're invested in the US and you're above $5 million, you're exposed to estate taxes. If you're above $5 million, you probably have a lot of assets that have accrued in value and have untapped capital gains that you need to plan for. So let's use $6 million, and also remember how few dentists achieve that amount, right, in their lifetime. Dentists aren't doing something proper. So let's all of us do what the 30% are doing and not the 70% of dentists. What's a family trust? The family trust is a vehicle by which assets are passed along, are conserved for the family. They're protected. In many ways, a family trust is like a corporation, but it has certain qualitative factors to it that provide better protection for what you end up amassing in your lifetime, what you end up generating both in income and also the assets that you want to pass along to your beneficiaries. Family trust, every single high net worth individual that I've ever met has a family trust or is eager to put one in place. And there's no secret that the wealthiest families in Canada and the United States use trust to be able to pass wealth from generation to generation to generation, okay? And that is something that we should all be taking advantage of. At what level of properties owned should you start a corporation? Well, for some people, one property, start there, okay? What's your take on REITs versus private REITs? My take is both are great. Private REITs have the added benefit of who is running the REIT. You know them and you can do your diligence on those people. You may also have a personal relationship with them. You may also have invested in prior activities that they've been involved in, prior investments, so you know their track record. A public REIT, the big issue with a public REIT is the dilution, okay? Public REITs will grow year over year because they're going to bring in more subscribers. That dilutes your ownership in the public REIT, okay? That doesn't tend to happen as significantly in private REITs. What worth should one have to make a family trust? I think one should have a family trust when you have assets that you want to pass along to your children, okay, or other beneficiaries. That's the first requirement. But a net worth for a family trust, well, higher net worth individuals tend to have them. And if we use that category of 6 million, if you plan to get to $6 million in your lifetime, you want to put a family trust in place. All right, so I'm going to get back to the questions after. Let me get back to the presentation because should you buy a real estate incorporation, which one is doing active business? So you shouldn't buy a corporation and shouldn't buy real estate in active businesses. I talked about that a little earlier, about the $50,000 maximum passive income amount that you're allowed now. So we want to cleave out active businesses from passive businesses. We want separate corporations, okay? So I'll get back to questions later. Let me get back to the slideshow because I'm already over my time limit here. So let's keep moving. So, I'm going to give you an example of transferring a property to a corporation, okay? So in this case, Andrew owns a rental property he purchased in 2012 for 500 grand. It's worth $1 million. He has a corporation. So this is a scenario. I'm giving you a scenario where you have a business. You have an active business. Maybe that active business is a dental practice. Maybe it's a medical practice. Maybe it's a automotive repair shop. Maybe it's a retail outlet. Whatever your active business is, maybe it's a construction company. Whatever it is, your business has done fairly well lately, and you have 600 grand sitting in there. It's in retained earnings. You know, if you take out that as dividends or salaries, you'll pay tax on it. So it's just sitting there. You're trying to figure out what to do. Well, in this case, Andrew has that business. He also has a personal rental property. If he sells his property personally, on that $500,000 capital gain, his taxes will be about $125,000, okay? However, if he transfers his property to his corporation, he'll still pay, I'm talking about at fair market value, he'll still pay the same capital gains taxes of 125 grand. But he'll be able to withdraw that $600,000 from his company tax-free. Why? Because the company owes him $1 million for his property, right? If he had withdrawn that $600,000 from his corporation another way, he would have had to pay $300,000 in taxes. So what did we just do here? We just saved Andrew $300,000 by transferring the property to his corporation that has retained earnings. He was able to pull money out that he wouldn't otherwise be able to pull out. So for those of you who have an active business that has any kind of retained earnings in it, here's something to think about. You might even say, I'm going to transfer my property to my corporation, then I'll sell it in my corporation, right? On a short-term basis. This is a way to be able to think differently about these personal properties you own and the gains that have occurred on it. So let me give you another example. So we just talked about the example of transferring it to the corp so you could get income out of the company on a retained earnings, out of the retained earnings. But here's an example for people who don't have a company yet, all right? Or maybe they have a company, but it doesn't have retained earnings in it. But nevertheless, we might decide, okay, I'm making an assumption here for this slide. So what we're talking about here is the inclusion rate for capital gains is increasing. So what we've pinpointed is there's a consensus among tax professionals, advisors, even among banks, that capital gains is going to go up. So we're saying the inclusion rate, which currently stands at 50 cents on the dollar, is going to 75 cents on the dollar. So here's an example. You right now have a property that's worth $1 million and you bought it for 500 grand. So your capital gains is on that, your taxable gain is 250. Your inclusion rate is 50%, so your taxable gain is 250. The taxes you owe on that property are 125 grand, okay? If it goes up to 75 cents on the dollar, the inclusion rate, or 75%, your tax is payable on this property has just gone up $62,500, all right? Now, I want to get to that page because I want to talk about that for a second. So, and if we go back, let me look at this slide for a second here. No. So I'm leaving that there, and then I'm going to go here. So we're saying that the tax rate on capital gains is going to go up to 75% as a consensus figure. It might not go up. Maybe all the tax advisors and the banks, etc., are wrong. Maybe the NDP won't sway the Liberal Party, or maybe the Liberal Party doesn't have it in their plans to raise capital gains, but everything seems to be pointing towards, you know, the massive Canadian deficit, only increases in people who are going to need social benefits, et cetera, et cetera. Everything seems to be leading towards increase in capital gains. So if it goes to 75%, your capital gain may be grandfathered. Maybe that's a good thing. Maybe it's reasonable to expect that they'll grandfather your capital gains over time and say, as of this date, your capital gains will be 50% from this date forth. They might be 75%. Well, we would say, okay, but what if they're not? What if they're 75% and it's retroactive to when you bought the property? What if that happens? Is that unreasonable to assume that could happen? I don't think it's unreasonable. In the past, they've grandfathered, but doesn't mean they'll do it again. So just by that very nature, that change, you're going to cost yourself $62,500 because you didn't choose to either sell the property or move it into a corporation. You could have saved yourself $62,500 by moving it into a corporation. You're not going to lose on this. You may have to pay land transfer tax depending where you are, but still the taxable difference would outpace the land transfer tax, okay? So this is what we're talking about here. The danger in doing nothing is that these taxes are going to raise and you're not protected, you're not mitigated against the raise, okay? Is the assumption that these properties are owned outright or have mortgages on it. It doesn't matter if there's mortgages on the property, okay? A mortgage does not change your capital gain. So I'll give you an example. Let's say you bought a property for 500 grand, it's now worth $1 million. People will say, I'm going out to refinance and I can get $1 million mortgage on my $1 million property, 100% loan to value. So my mortgage is $1 million, the property is worth $1 million, my property is worth zero, right? No, CRA doesn't care that you went out and got a mortgage. What they say is, what did you buy it for? 500 grand? What are you selling it for? $1 million? Your capital gain is 500 grand. What mortgage you have is up to you to deal with, okay? So how about primary residence capital gain? So, you know, there's that question, will primary residence, will your principal residence exemption be disappear? I don't know. There's talk that that might be happening. I would think that this capital gains tax is going to occur before something like that might happen. In the United States, there already is capital gains payable on your principal residence, okay? These are serious worries, I guess. The one I'm most concerned about is the rental properties. I think that's the low-hanging fruit, okay? So what we're saying is you can sell your property and lock in the gain now, or you can transfer it to your corporation and lock in the gain now. In either case, you're protected against increases in the capital gains, okay? Is it difficult to get financing if a property is held in a corp, if the corp doesn't yet contain substantial funds? So the answer is no. It's not difficult. People will argue with me, say, oh, it's hard. I had a challenge getting. So we are 6-7 years now into running this practice. We have been arguing since day one, buy a property in your corp. We have clients who have started with zero in their corp, clients who have started with minimal income, who have gone out and built up their corporations with properties in it to tens of millions of dollars of assets. How have they done it if it can't be done? There are challenges to running a business. There might be things like bare trust that you might have to use. There might be other things, but you know, these are ways to navigate. These are not dead ends. Our clients have grown their businesses, their corporations. The ones who have started out with strategy of using corporation for their first rental property have started it knowing, hey, I might have to go to a different lender, or the mortgage broker might advise me to use a bare trust. Whatever it is, there are things to be able to that you can do to get mortgages. And by the way, our RBC is really agreeable to lending to corporations right now. And it has to be a standalone corp, which, you know, not the layered corp, but that company out there once was much more difficult to deal with, now is more agreeable. All right. So let me get back to the slide. So that's my spiel on capital gains and what to do. If you know, we have to consider the fact that if we're doing an investment, all right, I used to be able to buy this income property and it's not generating very much income, but at least I know when I sell it, it's gonna go up in value, and I'm only gonna be taxed on 50% of that. So the fact that I didn't get income all those years makes up for, you know, is mitigated by the great after-tax return I get. Now your after-tax return isn't so hot, and you have to really determine whether or not your money can be better served either by using that in the corporation to buy the property or doing a different type of investment, okay? So back to the slideshow here. So we got about 10 minutes left here. I'm going to get through this, folks, because I know a lot of this is repeating our admonition to plan, to watch out for capital gains, to use corporations, trusts, and insurance. So RRSP meltdowns, TFSA maximizers, other topics. So one of our clients introduced us to the RBC info on RRSP meltdowns, and essentially an RRSP meltdown is this. You have a amount build up in your RRSP, okay? And you're gonna take out a loan on a line of credit, all right? You're going to get a deduction for that loan amount. Then you're gonna take the amount that you borrowed from your line of credit, you're gonna make an investment with that money, right? And that investment is gonna pay a certain amount, all right? Then you're gonna have your RRSP, and you're gonna deduct money from your RRSP, and the profits that you make on the investment you made will pay the taxes on your RRSP. And slowly over time, what you're essentially doing is you're replacing your registered funds with the non-registered funds tax-free. That's essentially this plan, okay? To give you an example, if you withdraw $30,000 from an RRSP over 25 years, you'll save $141,000 in tax doing this method. So it's not a ludicrous amount, but it's a savings, and it's something to think about. Now, the key point is that you're leveraging, you're borrowing money, right? So the RRSP meltdown isn't for everyone. Are you comfortable borrowing money to be able to invest? Now, granted, you might be making the same investments you're making in your RRSP, just outside your RRSP, but still it is borrowed money. And if you're in retirement and you're trying to sleep at night, it might not be the strategy for you. But I'm putting it out there because people are asking about it, all right? So it's something to consider. Let me just see what. All of which is why we have to talk about the tax alpha. Whenever you're doing an investment, we have to analyze the alpha. That is the difference after tax of what you're doing, not what the investment is going to produce, but after tax what you're doing. We introduced last year our strategy where a lot of financial planners were telling people to not draw down their RRSPs yet. Wait until their retirement. They'll be in a lower tax bracket. Wait until they're in retirement. We said, foolishness. Let's withdraw our RRSPs aggressively and early. And yes, you're going to pay more tax. You're going to pay more tax. You just heard that right. Your accountant is saying you're going to pay more tax in a particular period. But look at what we saved with our alpha period here. Over 18 years, by paying more tax early, we actually saved $131,000 over the 18 years. And this is the scenario we used last year, was a person who has a corporation and uses their corporation as the RRSP and tries to liquidate their RRSP as fast as possible. This is the savings, and that's why we want to focus on after-tax alpha of whatever you're doing. The analysis has to occur that way, okay? Let me go back one last time to the previous screen here, because insurance, by the way, is a big plus, and I know I mentioned it earlier, but insurance is one way we can mitigate RRSP taxes. Insurance is one way we can account for the capital gains that are payable. If we want a property to pass along to our kids, we can have insurance. But another thing we can do, similar to insurance, is we can make an investment. Let's say I have here's a good example. Let's say I'm planning on investing $300,000 in a U.S. limited partnership, okay? Instead of taking that money and investing in the U.S. limited partnership, because I have two goals out of this limited partnership. One is I want the income from it to support me in my retirement. But secondly, I want this to pass along to my kids in a tax efficient way. So instead of going out and doing this in my personal name, how about instead I go and get a trust, and I take my money and I put it in the trust, and the trust goes out and invests in that U.S. limited partnership, which holds rental properties, okay? Now I can still benefit from the trust. I can get income from it, but my children are beneficiaries of that trust, which means when I die, they just got that investment tax-free. They can get the capital gain on that deferred to them. They can get the income that it produces in their name without any transfer implications. So here's an alternative to insurance. Insurance is I can get the tax or I can get insurance to pay the tax on that investment in the LP, or I can invest this way in a trust, and that's my own form of insurance, okay? Something to think about. Last thing I'll take here is the TFSA Maximizer, and then I'm going to go to questions. So the TFSA Maximizer is a strategy a lot of people are talking about, and here is how it works. Let me finish the screen here and you can see me talking. So, when transferring a rental property at corp to a personal ownership, how does this affect the mortgage on the property? So good, and we have all kinds of mortgage brokers on this. That's definitely something to work on with them. You may want to choose to transfer your mortgage when you transfer your property to a corporation when the mortgage comes due, or your mortgage agent or broker may be able to assist you with transferring or porting the mortgage, but those are definitely things to consider, okay, because there may be break fees, who knows. So the TFSA Maximizer. So essentially here's what we're being told that people are saying. What they're saying is there's one strategy where you pull the money out of your RRSP and you purchase or you put it in a TFSA. Let's say it's $50,000 and the TFSA holds shares in a mortgage investment corporation. And along with doing that, you also take $50,000 and you invest in this mortgage investment corporation. So you have a TFSA that owns shares and you have a private investment. And your $50,000 in your personal name pays you a rate of return, let's say 3%, gives you 3% interest. Your corporation gets 19% interest. So essentially what they're trying to say is you might only have $50,000 in your TFSA, but you're able to maximize it because you're getting a premium for investing with your TFSA. All right. Another one that's very straightforward that doesn't even use a mortgage intermediary is simply, hey, invest in my product over here in your TFSA, give us 50 grand, and invest in our rental property REIT over here and give us 50 grand in your personal name. So we'll pay your TFSA 20% and we'll pay you personally 13%. So what I say to that is, and people will tell me over and over, it's legal. We've checked, they've told us it's legal, and CRA doesn't have anything against this. And here's what I say to people. Show if these people are big enough to be a promoter of these types of investments, okay, then surely by now they would have had their tax advisor submit a request for a ruling to CRA, an advanced tax ruling. That's all. All you need is an advanced tax ruling from the CRA, which answers the question, is this abusive tax planning or is this legitimate use of your TFSA? And as long as, if they were willing to go through all the trouble of setting this up and holding videos and doing all these things to promote this, surely they would have crossed their T's and dotted their I's by making sure that they got that advanced tax ruling from the CRA. Well, I haven't seen a single advanced tax ruling from the CRA yet. Okay, so someone had said, well, they don't have time to go off and get the advanced tax ruling because this has to happen quickly. You don't have time to do it that way. I don't think that's a legitimate answer, but I would say, okay, secondarily, the best tax attorney in Canada, the best tax lawyer in Canada is Daniel Sandler at Ernst & Young. It'll cost you $975 to go sit with them for an hour. Take this strategy, go sit with him for an hour, spend $975, and come back and tell me what he says. That's it. So that's my only comments on the TFSA. Having said all that, you can see where I fall as a former criminal investigator and auditor. If this came across my desk, I would call this abusive tax planning, because there is zero reason that I make the same investment, but it pays 19% over here and only 3% over here. There's zero reason for it, in my view, as a former auditor and investigator. But I'm willing to concede maybe CRA wouldn't have a problem with it. We just don't know yet. Okay, so let me see this. If I had any other items to talk about in there, no. Tax alpha, I talked about tax alpha. Maximizer. Oh, I want to show you what the outlook is for 2021. Sorry, last thing. Here's what we want to see people investing in for 2021. I wouldn't say want to see. Here are what we think are opportunities for 2021. Okay. So here are the yeses. U.S. multifamily residential, still highly undervalued, still cash flowing, still producing income for people, still accessible with relatively small down payments, still available with vendor take-back mortgages, still all kinds of creative financing strategies available. So for someone who's looking to grow a portfolio, you know, this, I would be all over this if I was younger and wasn't busy with 3 children and coaching a hockey team and wanting to golf and break 80. But these are the things, if you're looking to growth and make great money, these are opportunities. Cash flowing REITs, LPs, you know, these are preferable in our view to private lending right now. These are the opportunities, okay? If, you know, there are some good private lending opportunities out there, for sure. These would be ones where you know the track record of the person, where you have some personal familiarity with them, where you have a good understanding of their business plan and the underlying assets, but just keep in mind that they are not secured. At least with REITs and LPs, there are underlying assets securing them. Warehousing and storage, we talked about this last year. I cannot believe the boom in warehousing and storage rental units right now. It is off the charts. Everybody is hoping Amazon comes along to take over their unit on a sublease. These are major opportunities. Purpose-built rentals continue to be transit-oriented. Seniors and long-term care, yes, yes, yes. Anything with a 4-person room is going to have to be torn down and rebuilt now with this latest pandemic. It's just the fact of the matter, okay? The government is going to take a much bigger involvement, I think, in the management of these than they have been previously with simply hiring private companies. Fix and flips, great opportunities still. Look, the RBC just came out with a statement that 2021 property across Canada in 2021 is going to be a really good year. All right, property values are going to continue to go up. That means demand is going to outpace supply in the near term. If you can get an undervalued property, you have the acumen, the ability to flip it by fixing it up. Great opportunity for you. And insurance, great opportunities, insurance, because you can buy insurance policies that you can then use to go off and buy REITs, buy LPs, buy properties, and so on and so forth. Here are the no's. Retail, are you kidding me? There are endless number of empty retail outlets now on the streets in Toronto. I'm assuming it's the same in countries all across Canada. Retail is not where you want to be. Commercial space, our experience is that landlords are super agreeable now and lowering their rents to keep the current tenants in place. Single family homes, still a challenge because they don't cash flow, guys. These are about speculation. Single family homes are so expensive that they don't cash flow. Condominiums don't cash flow. Fix and flip, why is it on the no side? Because you're going to be brought to your knees if you don't know how to do this. There's no room for tire kickers in here. Okay, so that's our investor outlook for 2021. I wanted to go over that because last year we gave this, and it was fairly similar last year in that we were against commercial and retail last year, and hopefully people listened to us last year, because you would really be struggling right now if you bought retail outlets, commercial outlets. So I'm going to end the show there. We're going to get to questions now. That's the end of what I wanted to talk about here for 2020, 2021, you know, emphasizing the things that you will want to start doing differently. So let me see. Now our hybrid vehicles deducted. Hybrid don't fulfill the electric vehicle area. So as far as I know, hybrid are not part of that. Will you please explain how insurance works? So insurance, in your corporation, you'll have a class of insurance shares. Your corporation then goes and deals with a broker who knows how to structure an insurance policy for corporate ownership, whether it's the one that you can borrow against or whether it's just a flat insurance policy. Either way, your corporation is now the beneficiary of that insurance policy, you will have your children subscribe for us or other beneficiaries subscribe for a particular class of share in your corporation called a life insurance share. So they don't have any right to the net equity of your company, and they have no right to dividends or anything else, but they do have a right to the insurance that the company eventually gets. You'll get to write off the premiums. When you pass away, the corporation gets the insurance and pays it out to your beneficiary tax-free. The name of the insurance is corporate life insurance, and there are multiple types. You'll need to deal with a broker. IFA is is an insurance type that we talked about where you can leverage against it. Okay, immediate funding agreement, it's called, arrangement, immediate funding arrangement, IFA. That's where you go and buy a $150,000 policy and you can immediately borrow the $150,000. Okay. Has to have a plug. I don't know what that is. Oh, for whether a vehicle is, okay. So thank you. Marlene says it has to have a plug in order to be called an electric vehicle. Can you do a voluntary deemed sale of your properties to lock in? Yes, absolutely. Absolutely. You have to sell the property to somebody, though. You got to make an actual transfer. You can't make the transfer to yourself. So that's why we're saying do it to a corporation. Is it life insurance? Yes, it's life insurance that I was talking about. That's what your corporation buys. It buys life insurance for you, the owner. Okay, instead of you having life insurance in your personal name, which you don't get to deduct the premiums on your life insurance in your personal name. That's not, despite the fact that we have clients every year who send us their life insurance premium and say, I want to write this off, you can't. There's no reason to write off your personal life insurance. However, if the corporation insures you, right, and you die, now the corporation gets the benefit of that, and in turn, your beneficiaries can get it. How do we best work with your firm for tax planning? Well, certainly the clients who are working with us for tax planning, when we have workshops like these, afterwards we'll want to set up an appointment to talk about what they're doing, what their plans are for the year, their assets, etc., and where they want to end up going, and then we devise some sort of structure for them to follow. Are Teslas still deductible now? Yes. I have it in my personal name, of course. No, not deductible. So you had to buy a Tesla in your business name for it to be deductible. If you bought it in your personal name, you're out of luck, unfortunately. But the business insurance payment is not taxable. No. So your insurance that gets paid to the corporation is tax-free, not taxable. It goes out to your beneficiary, tax-free. Just like in your personal name, it's all the same, except it's in the corp and it goes out this way, right? It's why we want insurance in the corp, not in your personal name. Again, speak to the folks at SafeBridge, Chris and Elise. This is a product that they've been promoting for a while now. And, you know, Chris has written articles about this. It's really a really good product. If you already have life insurance in your personal name, can you transfer that to the corporation so the corporation pays for it annually? No. You need a new policy in the corporate name. How you can get that, the best way to do it, you'll need to talk to an insurance broker because that's not my specialty. But you can't transfer your policy in your personal name and transfer the corp. It's an entirely different policy that has to get created. Any other questions, folks? All right, so doesn't the corp need to be able to qualify for the mortgage if you try to sell your personal property to the corp, or would you use a bare trust? You could use both. You can sell the property to the corp and use a bare trust, or your corporation would have to qualify for the mortgage. But as we've talked about, it's not, if corporations could not qualify for mortgages, then our clients would not have grown from owning 0 rental properties to owning dozens of rental properties. And I'm not talking about a couple of clients. I'd say we've probably got, you know, 10% of clients who choose investment properties who start off with nothing have been able to grow using that strategy. All right. So they would not have been able to do it if they couldn't get mortgages in your corporation. If we've got 1,000 clients, we probably have 100 clients who have done that using corporations. Qualify rules on churning and making money in TFSA, trading options, etc. You can't trade options in a TFSA anyway, but TFSA is a really scrutinized one right now. CRA is really making sure that people are not trading in their TFSA. And that's where the abusive tax planning is coming in, and they're holding people to account for this. So it's something to watch for. What strategy would you use with your RRSP portfolio? So my strategy with my RRSP portfolio is contribute to my RRSP in years when my taxes are really high, take my RRSP money and invest in income producing investments like REITs. You know, a lot of our clients, so one of our clients presented with us last year at Toronto, Ray Ostrander, switched everything over to REITs this year. Why? Because they're high dividends, yields. You can use RRSP funds. You can use TFSAs. You might want to reach out to Ray if you're looking. Many of you are already invested with him. You know about that. Other clients, Lori May Peroff is opening up a real estate investment trust. Terrific. You may already be dealing with Lori May. If you are, inquire about what she's doing. Right, there are others out there. Some of you have been with other investment opportunities that are considering REITs. Send them to us. We'll guide them through the process, how they create a REIT, okay? Can you transfer property to a corporation if you have a HELOC? Absolutely. Absolutely you can, yeah. Is there a property value limit you recommend per corporation? So we used to talk about that, right? Mitigating the, you know, one of the primary reasons you're going to use a corporation is to limit your exposure, your risk, your liability, and give you protection. And we talked about $1 million. $1 million is nothing now. You know, one building is $1 million. So we've got to up that. And there is an amount that you want to maximize. We like to look at what's coming in, amount you want to consider a maximum. So, you know, if it's 2 million, if it's 3 million, somewhere around there, but we don't want you buying $25 million in different properties all in the same corp. Is it worthwhile to cash them in to do so? Cashing in your RSPs, you got to, you know, we talked about the analysis I gave, which is draw your RSPs early and aggressively. If the plan shows over that 18 years that we used in that example, you'll be ahead. So do the analysis and figure it out. Linda Barron, Ray Ostrander is his name. And if anyone is interested, I'll send you his contact info. Bear Trust is spelled B-A-R-E. A bear trust just means I bought something for someone else. I'm holding it for someone else. It's not mine. There's nothing else in this trust, but I'm holding it in trust for somebody else. It's a very common way to purchase something. Someone might use the word conduit or nominee. In this case, a bear trust is a way for you to buy a property in your personal name, but hold it for your corporation, so your corporation gets the tax benefits. Even after the purchase, I'm confused when you said we can't trade within a TFSA. You can absolutely trade within a TFSA. See, you can't trade options in a TFSA. CRA is cracking down on people who are trading in their TFSA as a profession, okay? Day traders, in other words, people who are doing so many trades that they're no longer using the TFSA as just a tax savings vehicle, but are using actually as an abusive tax measure. So people who are trying to professionally use a TFSA to grow by way of trading constantly. And where's the cutoff? What is that requirement? I don't know. It's partly a judgment call. It will be based on their analysis of how many trades get made, et cetera. But of course you can trade in a TFSA, and you want to, you know, buy stocks. You can't buy Bitcoin. I bought some Bitcoin recently. Might be something to consider. Once I sell a property, applied against me or against the beneficiary of the Bear Trust. So the Bear Trust is not included in the capital gains tax. It's against the beneficiary. Okay. I'll take a couple more here and then I'll cut it off because I know some people got places to go. The point to make, folks, is there are better investments out there. There are some good ones we're seeing here coming in for 2021. Cash income producing. There are better ways to protect yourself. You need a plan, you need a strategy, okay? Especially regards properties you own, which have capital gains on them that are untapped. Need to do something about those. So set up a time to talk to us. Call Melanie, email Melanie at our office to book a time to talk to me or Alan or Giovanni or Bell or whoever. Okay. Once I sell a property, do we need to create a bear trust for each property, or can you need multiple bear trusts for each property that you buy? Mortgage companies have included in contract that bear trusts are not allowed in the deal. I hear you. So you're going to have to disclose it to mortgage companies in those occasions. Okay. Mortgage companies are more than willing to write mortgages to bear trusts if it's disclosed to them. What they don't want to see is areas where it's not disclosed. People still do that. People still get mortgages without disclosing it to the bank, and they take on the risk of doing that. And it's a common strategy, but Rob's point is right that some mortgage companies have decided bear trusts are not allowed, and they might hold you accountable. What about taking your personal property and putting it in a company, selling it to your company? That's exactly what I just talked about. That's the strategy we want people to be doing, to lock in your capital gains and be able to pull tax-free income out of your company. That's exactly the strategy we want you to be doing. Dave, is there a fee for a first-time consultation? So we've talked, we've built this business to where, you know, we'll have over 1,000 people at tax time, and it's hard to get to everybody. And we do charge $275 for a consultation. What I would say, if you're on this call and you need some of these services and you're going to move ahead in 2021, you're going to make something happen in your life to make things better, either investments, planning, strategy, then call us and we won't charge you for the consultation, okay? Make an appointment, say I was on the workshop and I need to talk to Dave or Alan or Bell or Giovanni or Johnny or Jeannie or whoever, all right? So let us do that. Good. All right, 157. My voice is almost gone. I got less folksy as we went along. The the spreadsheet or the PowerPoint will be available for all of you to see, and it'll probably be better on your own screen. I want to thank everybody for showing up here to talk about this today. And again, congratulations for doing this. You're taking these steps. These are important steps. This was free. You're already clients of us, most of you. So we're, you know, you didn't have to do this, but it shows how serious you are. Let's take the next step now and keep it going. Thanks, everybody. All the best.